In this video, I'm going to show you how you can evaluate investments that generate cash flow for you, not because they help you sell more product or sell additional product. So they don't generate additional revenue, for example. Rather, the way they generate cash flow for you is by helping you cut down on costs. So these are cost-cutting projects, and we're going to go through an example where we can see how we can determine whether a particular project is worth undertaking based on its cost-cutting potential. So this could be like an inventory management system or some sort of a software that just helps reduce costs. So here's an example. Suppose Hot Dogs Incorporated is evaluating a new sausage system with an installed cost of $465,000. So Hot Dogs Incorporated presumably makes hot dogs, and now it's introducing a new piece of equipment like a new sausage system. Now the cost of this system will be depreciated straight line to zero over the project's 5-year life. So this tells us that at the end of the 5-year life, the book value, which is how much the sausage system is going to be worth on the books, is going to be zero, right? Because we're going to be fully depreciating it. However, at the end of its useful life, the sausage system can be salvaged for $61,000. So this is how much you'll be able to sell the sausage system for at the end of its useful life. This is its salvage value or market value, which is different from the book value. And as we'll see, when the salvage value, or how much you can sell it for, is different from what it is worth on the books, you have to pay taxes on the difference. And so the point is that at the end of its useful life, when the system will be sold for $61,000, Hot Dogs Incorporated is not going to get the full $61,000 because they're going to have to pay taxes. So we'll see. The sausage system will save the firm $143,000 per year in pre-tax operating costs. So this is an important point. Let's suppose that right now the operating costs are $243,000. What we're saying is that after the system will be installed, this system is not going to help Hot Dogs Incorporated sell more hot dogs. Rather, it's going to reduce its operating costs from $243,000 to something like $100,000. So that if somebody asks, how much did they drop by? What is the change in operating cost? What is the change in operating cost? You say, well, today they are 100,000. They are 100,000 today, and they used to be 243,000. So the costs have actually gone down by 143,000. So the negative here indicates that the costs have gone down. The change is downwards, right? The costs have actually gone down. And this is the critical feature of cost-cutting projects. Incremental sales from these projects are zero. There are no additional sales, no incremental sales, but they generate cash flow because the incremental costs are negative, or the costs have gone down. So that's the first thing, okay? The other important thing for you to realize is that this is happening pre-tax. This is important because while at first glance you might say, oh, so this is great, I'm going to get the full benefit of the $143,000 that I'm going to save. Well, no, because when your costs are going to go down by $143,000, your taxable income is going to go up. And as a result, you'll have to pay more taxes as well. So we have to account for the effect of taxes on our cash flows from this particular investment. The question further states that the system requires an initial investment in net working capital of $27,000. So we can think of that as maybe upfront investment that might be required in, say, inventory. So what this means is that throughout the life of this project, about $27,000 will be tied up in something like inventory. Even if we sell more inventory, we'll have to go and buy more, so that at any given point in time, we will have $27,000 tied up in net working capital, say potentially in the form of inventory. And then finally, if the tax rate is 22% and the discount rate or the required rate of return from the investment is 10%, the first question is, what is the net present value of this project? So let me show what I've basically done here now. I have separately created an input section. This is useful because I can put down all the numbers that I'm given, like the capital expenditure, the salvage value, how much the operating costs are going down by, which in this case is $143,000. Initial investment in net working capital, tax rate, discount, all of that is here. And then over here, I have my setup, right? So this is the setup which will help me determine the financial cash flows of the project. And recall, financial cash flows are calculated as operating cash flow minus capital expenditures minus change in net working capital. Recall, where operating cash flow further is essentially sales. You subtract your, cash costs, which are everything essentially except depreciation, because depreciation is a non-cash cost. You basically say, okay, I'm going to see how much of this is left after taxes, and then you add back depreciation. So I've talked about all of this in a separate video. So all of the stuff that I'm doing here is essentially the implementation of this particular equation. So very quickly, what I'm going to show you is what I'm doing here. So first with sales, notice that in years 1 through 5, I have 0 sales. This is very, very important. It is not that as a result of this system, you're not going to sell. You will be selling hot dogs. It's just that you're not going to be selling any more hot dogs than you already are with the current system. So there are not going to be any incremental sales, okay? However, your incremental costs are going to be negative $143,000. So in each of the following years, you have negative $143,000 in operating costs. The reason why this is important is because when I'm going to calculate earnings before interest and taxes, where I'm going to take sales and subtract costs, because these incremental costs are negative, my earnings before interest and taxes is going to be a positive number. I'm going to be subtracting a negative number. And intuitively, this should make sense. Because our costs are going down, our earnings before interest and taxes is going up. Additionally, you have to account for depreciation. We were told that depreciation is going to be straight line. So all that I've done is basically taken the capital expenditure numbers divided by 5, which is 93,000. So each year our asset is depreciating by $93,000. In the end, the worth of the assets on the books is going to be 0 because you're fully depreciating it. And to help you see that, and this is useful, what I've done here is right at the bottom, I've also recorded accumulated depreciation, which is how much the asset is depreciated in total over its useful life of 5 years, and then what is the book value at each stage. So not surprisingly, when the asset depreciates by $93,000 in the first year, the book value now is simply the difference between how much you paid for it, which is $465,000. And from that, you subtract accumulated depreciation to figure out the book value. So by the end of the first year, the asset is worth $372,000 on the books. Next year, the total depreciation would be, how much the asset depreciated by in the first year, plus however it depreciates in the second, so on and so forth. So by the end of it, the asset is fully depreciated and the asset is worth $0 on the books. So now, we know that this project, therefore, will result in an earnings before interest and taxes of $50,000 every year for the next 5 years. We have to implement taxes on it. Fortunately, we are given a tax rate of 22%. So we're going to say, okay, 22% of this number, that's in taxes. So I get my EBIT into 1 minus the tax rate. This is how much of the EBIT is left after taxes. And then to that, I will add my depreciation number. So to that, I add back my depreciation of $93,000. So long story short, we know that from this project, we will get operating cash flow of about $132,000 every year for the next 5 years. We are not done because we still need to account for how much money we're spending upfront on equipment or CapEx for this, which we know is $465,000 at year 0. At the end of 5 years, we will be salvaging the asset for $61,000. However, we will not get this full amount. Why? Because the asset is only worth $0 on the books. And so whenever you sell an asset for more than what it is worth on the books, the IRS says, hey, you're making a capital gains or quote unquote profit, and I want my share of that in the form of taxes. So basically, when you go and sell the asset for something like $61,000, which is cell N4, this equation is saying that you're going to get N4 less the taxes, the 22% taxes that you owe on the difference between N4, which is 61,000, and what the asset is worth on the books, which is 0. And so when you do that math, that comes out to 47,580. I further multiplied this number by -1. Why? Because I'm going to be subtracting CapEx, and I want to subtract this number needs to be negative so that when I subtract it, it actually increases my cash flow. The idea being that this is a number that is coming into the firm and not going out. It's a cash inflow, not an outflow. Finally, the question specifies that there's an initial investment in net working capital of $27,000 required. So notice that I have $27,000 here, and then consistently net working capital of $27,000 is tied up in each of the next 4 years. In the final year, and this is the year in which the project is getting wrapped up, you will not need net working capital, which means that your net working capital has to go down to 0. And so with that, then therefore we can calculate change in net working capital, which is what we need for our financial cash flow calculation. In year 0, your net working capital went from 0 to $27,000. So change is the same as the actual amount. But in subsequent years, notice that the change is nothing, right? Net working capital at the end of first year is 27,000. At the beginning, it was 27,000. It hasn't changed. Doesn't change here, doesn't change here. However, in the last year, because your net working capital is dropping from $27,000 to 0, change in net working capital is negative $27,000, which is again indicating that $27,000 that was initially tied up is no longer going to be tied up anymore. So this is money that we are going to see coming into the firm. And so with that, we can calculate financial cash flows associated with this investment. Financial cash flows are simply operating cash flow net of capital expenditures and any changes in net working capital. And so that tells us that the financial cash flows are going to be these numbers right here. And since we are given a required rate of return of 10%, so if you scroll up, the discount rate is given 10% here. And so based on that, I can calculate the net present value of this. Part B of the problem asked, how would your answer change if the new system qualified for 100% bonus depreciation? So as background, the Jobs Act basically allowed small and medium businesses to record bonus depreciation. What that does is that for certain CapEx, you can actually depreciate it fully. What that means is, in the context of this question, that if you spend $465,000 on a piece of equipment, rather than depreciating it over the next 5 years, you could say, you know what, I'm recording 100% depreciation or bonus depreciation, which means that you would have depreciation of $465,000 right here. That means that you can't have, of course, depreciation the following year, so you'll have 0 here, 0 here, 0 here, and 0 here. And so notice that it is still true that the book value of the asset is going to be 0 by the end of its useful life, but now actually book value was straight right off the bat 0 because you depreciated the asset fully using 100% bonus depreciation. That is all that you need to do here to see how this would influence your net present value. Not surprisingly, your earnings before interest and taxes actually becomes negative. This is great because technically this allows you to save money in taxes. So when I say taxes are $70,840, what this means is that you're actually showing that your taxable income went down by $70,840, which means that you had to pay less in taxes. And so because there is more cash coming from this project early in its life, this means that the net present value of this project is also higher than it was before. So that is how these calculations would get influenced. If the only thing that we're changing is that rather than having straight line depreciation, you have 100% bonus depreciation. And finally, the last part of the question asks, how would your answer change if the new system falls in the 5-year makers class and requires additional $3,650 in inventory for each succeeding year of the project? Okay, so there are two things changing here. First, depreciation. Notice that we're not saying depreciation is $465,000 and then zero throughout. In fact, we're saying depreciation is following the maker schedule. Now, if you scroll below in this question, I have the maker schedule right here, which shows how assets need to be depreciated when they fall under certain classes. Like, so for example, the 5 years maker schedule says that you should depreciate 20% of the initial cost in the first year, 32% in the second, so on and so forth. And so what I'm going to do here then is basically record depreciation that is consistent with the maker schedule. And so that is exactly what I've done over here. For example, if you look at this 93,000, this is basically me multiplying 20% by the original capital expenditure amount, which was $465,000. And in subsequent years, I'm doing exactly the same thing. So for example, in the second year, the depreciation expense is 32% of that number, so on and so forth. What is worth noting here is that the way the depreciation is happening, and this is why this calculation that I've done here below is useful, you'll see that by the end of 5 years, the asset still has some book value. It doesn't get depreciated fully. And that has implications for how much we will get when we will salvage the asset. So that is why this cell referencing is useful here, because now my tax liability will be a little bit lower, right? Because the asset is still worth something on the books and I'm selling it for something a little bit higher. So I pay taxes, but not as much when the asset was being fully depreciated. Regardless, we do need to account for any tax liability. So again, we're not getting the full salvage value of $61,000, but something which is now a little bit closer. The other thing that we then need to focus on is the other piece of information that was given, which is what if this project requires additional $3,650 in inventory for each of the succeeding year of the project? What does that mean? This means that if the initial investment in net working capital was $27,000, in the next year is going to be $27,000 plus $3,650. This is what it's going to be. So that the change in net working capital is $3,650. And in the subsequent year, it's whatever this was plus another $3,650. And then in this year, it's again this number plus $3,650. And then finally in this year, it's whatever it was previously plus $3,650. So in each of the subsequent years, your change in net working capital is $3,650. But, and this is critical, at the end of the project's life, net working capital has to go down to zero because you don't need inventory or any other working capital anymore because the project is ending, which means that in the final year, your change in net working capital is going to be basically $41,600 negative. So all this money that was tied up at the end of year 4 in net working capital is going to get released. And so this is why it is often useful to make a separate row for net working capital and then change in net working capital, because it makes it easier for you to sort of track what the changes are. And then the rest is simple. You calculate financial cash flow as operating cash flow, net of capital expenditures, and change in net working capital. And so the NPV calculation proceeds the same way as before. And so this is how you can evaluate cost-cutting proposals.